There's a number almost no one talks about. Yet a man sitting on roughly $344 billion, 0 cents of dry powder, doesn't ignore it. He waits, he measures, then he moves, quiet as a farmer, checking the weather before planting. Folks chase headlines. He watches this number flip from red to green. That flip is the difference between maybe and buy. Not a secret formula, not a magic chart. A simple gauge that tells him when price stops arguing with value. Today I'll show you how to spot it, why it works, and how to use it without guessing the market's next mood swing. Short sentences, plain steps, no hype. Let's go find that green light. Here's the deal. You'll learn why holding cash is not fear, it's optionality. You'll learn how price and value drift apart when crowds panic, then snap back like a rubber band. You'll learn the simple rule that tells you when to swing and when to stand still. But build a small playbook, a watch list, buy zones, a cash sleeve, and a way to scale in without drama. We'll answer the big objection, but cash loses to inflation. And we'll walk a mini case so you can see the gears turn. No predictions, just process. Confidence in the method, humility about the future. Hey, you've heard it. He's hoarding cash, CPI's high, rates bite. Why not buy now? Because the goal isn't to always be doing something. The goal is to be ready when the world hands you a fat pitch. Inflation grabs headlines, debt ceilings grab ratings. But their businesses are built on cash flows, moats, and prices you pay for those streams. When the gap between price and value is thin, patience is the edge. When the gap widens, speed is the edge. That's why a record cash pile matters. It's a spring, compressed, not a mattress. The number helps you see when the springs should release. Not every week, not every month, sometimes not for years. But when it flips, the move can define a decade. Cash is not an opinion. It's a permission slip. Optionality means this. You can say no 1,000 times and yes once with size. When the market is calm, your cash earns little, sure. When the market is scared, your cash buys time, leverage, and terms. Vendors need liquidity. Sellers need relief. Strong hands name the price. Speed matters during panic because windows open and close fast. Optionality turns patience into power. You're not timing the perfect tick. You're buying the right business at the right discount while others freeze. So that's the first function of the number. It tells you when optionality is worth more than yield. Value is the farm, price is the quote of neighbor yells over the fence. They wander apart, sometimes far. The fat pitch appears when a good business, durable moat, honest management, cash that piles up, sells at a price that assumes a much worse future than reality. You don't need 20 ideas, you need a few you understand. The number helps you judge when pessimism is already in the price. Think of it as a temperature check. Too hot, walk away. Cool enough, get ready. Cold, bring the bat. Well, you don't forecast the weather. You read the thermometer and plant when the frost breaks. Markets don't fail because math is hard. They fail because people are human. Liquidity dries up when fear spikes. Sellers outnumber buyers. Quotes gap, spreads widen, screens look ugly. That's when stories get louder and signals get quieter. The number I'm pointing you toward filters the noise. It's built from things that don't lie easily: cash generation, reinvestment runway, pricing power, and the multiple you're forced to pay. When liquidity vanishes, the multiple compresses. When psychologist swings back, the multiple expands. Your edge is to buy the cash flows when fear has already done most of the compressing. Not bravado, just arithmetic tied to human nature. Start with a prepared watch list. 10 to 20 businesses you'd love to own at the right price. Know their moats, know their normalized cash, know the warts. Set. Buy zones, not single prices. Think ranges. At 15, 17x, owner earnings start. At 12, 14x, lean in. Keep a cash sleeve. Size it to your temperament and income. Enough to act when it matters, not so much you itch to use it early. Plan your scaling. First, bites small. Next, bites larger as the discount improves. Write the plan down. Panic erases memory. Paper remembers. Then wait. Watch list saves time. Buy zones save nerves. Cash sleeve saves the day. You're right. In quiet times, cash trails inflation. But we're not holding cash for yield. We're holding it for yield on opportunity. Think of cash as dry powder. If you use it once every few years to buy great cash flows at 30, 40% off, your long-run return can jump far more than the couple of percent you gave up while waiting. Inflation punishes idle cash. Panic rewards ready cash. The trick is honoring the cost of waiting by making the wait pay. Discipline is the toll. Opportunity is the bridge. If you refuse to swing at bad pitches, you'll have more ammo for the great ones. That's how cash beats inflation. On the swing, not to sit. Picture a sturdy consumer brand. Wide shelf space. Price hikes stick. Cash pours out. In a storm, the multiple compresses from 22x to 14x. Headlines scream. Funds for sell. Your watch list says, fair at 18x, wonderful at 14, 15x. You've kept a 20% cash sleeve for years. Felt silly at times. Now, bids vanish at the open. You place 3 resting orders inside your buy zone. First fills early. Second fills on a margin call wave. Third fills when the scary rumor hits. Weeks later, fear fades. The multiple retraces to 17, 18x. You own a compounding machine bought at a pessimism price. Cash didn't beat inflation by sitting. It beat inflation by striking. Entries, never all at once. Scale in across your zone. Let volatility work for you. Sizing, concentrate on the few you truly understand. Diversify across unknowns, not across names. Big, where conviction meets discount. Small, where it doesn't. Stops, fundamentals, not price. Sell when the business case breaks. Moat damaged. Incentives sour, secular shift you can't model. Exits, trim when price races far ahead of value and reinvestment is thin. Don't milk the last drop. Hygiene, write a one-page thesis, date it. Reread it on red days. The cadence, review watch list monthly, buy zones quarterly, theses yearly. Simple beats clever, process beats mood. So what's the number? Owner earnings per share against the price you pay, not reported EPS, not headline EBITDA, cash that a real owner could take out after the upkeep, before the dreams. Track its yield, owner earnings / market cap. Track its growth runway. Can they reinvest at high returns or return cash? When the owner earnings yield clears your hurdle and the moat still holds, that's your green light. It compresses in fear, expands in euphoria. Tie it to your buy zones, tie it to your sizing. It's humble math anchored to business reality. That's the point. You don't need to predict the rain. You need a roof and a plan. Optionality buys time. The number buys courage. When price stops arguing with value, you'll know. The yield will tell you, the moat will back it up, and your cash will finally have a job. That's how quiet money moves. Slow to anger, quick to act. If this helps, stick around. I'll break down owner earnings in plain English next, and we'll build a simple tracker you can use. No hype, just the work.